welcome to our discussion on FIF tax and how it affects investors. Today's discussion is general information only and not specific FIF tax advice. If you do need advice, please consult with your appropriate advisor. I'm Brittany, and joining me is Richard Austin. Richard, thank you for being here.
Thanks for having me, Brittany, and it's great to be here.
Let's start with the basics. What exactly is FIF tax?
Sure. So FIF tax, or FIF as you'll sometimes hear it referred to as, stands for Foreign Investment Fund. So that's a tax regime that applies to New Zealand tax residents who have investments in overseas entities. And the idea is to tax the income and gains from those overseas investments, even if it is distributed as dividends. So it's important that people are aware the tax does apply to overseas investments, but that doesn't include overseas bank accounts or overseas term deposits, and wouldn't apply to, say, an overseas rental property.
Okay. And why is FIF tax important for investors to understand?
It's important because it does affect how the bulk of your overseas investments are taxed. So if you're not aware of the FIF tax and its implications, you may end up with an unexpected tax liability. So understanding the tax regime does help you plan better and avoid surprises out into the future.
Richard, what type of investments are subject to FIF tax?
So generally, this tax applies to shares in foreign companies, in foreign unit trusts, and interest in foreign superannuation schemes. However, there are some exemptions to being caught by the rules around FIF tax. And firstly, the first rule for an exemption is that if the value of your foreign investments is under $50,000 at 31 March, then the FIF tax doesn't apply. And also there are listed certain Australian shares that are listed on the ASX or the Australian Stock Exchange that are also exempt from the FIF tax. The New Zealand IRD has a schedule of those companies.
Okay. How is FIF income calculated or FIF tax calculated?
Yes, so there's generally two main methods that are used. The first one is what's called a fair dividend rate, or FDR method, and the other one is a comparative value method, CV method. And the FDR method, fair dividend rate, taxes 5% of the market value of your investments at the start of every tax year, while the CV method taxes the change in value of your investments over the year. So if you do use the CV method, just be aware that if the outcome of that calculation is actually negative, so in other words, your portfolio has gone down in value over the year, you don't actually get a tax loss. It's just that you don't pay tax that year.
And which method should investors use? Is it easy for them to figure out?
Not always easy, but there are some guidelines and some sort of things that you need to think about to work out which of those two methods you should use. So the first is that your own specific situation will dictate one method or the other. And the other, and probably most important, is the performance of the international investments for the period that you're looking at. So the FDR method, that's the fair dividend rate method, is definitely simpler and often preferred, but the CV method might be more beneficial if your investments have decreased in value over that year. So it's important to ensure that you're if you have an accountant, that you use them to help you select the most beneficial option, or your financial advisor at CP Wealth will be able to guide you as well once you've received your tax reports.
Great. And what about any considerations for years with different market performances?
The method you use is going to be driven pretty much by the portfolio performance. And as we know with shares, they perform differently at different times of the year. So it's important to realize that you can't select some investments to be under an FDR calculation and some of your investments to be under a CV calculation and try to cherry pick that way. If you do choose one of the calculations, then you have to apply that to all of the foreign investments under the regime. And so when you think about it in that way, it does help guide you to which method, in fact, would be the most beneficial.
Makes sense. Thank you, Richard. It's been incredibly informative. Are there any other final tips that you've got?
I think investors should be aware of this foreign investment fund tax and regime. And what we do know at the moment is the government are looking at the FIF regime. And it's something that we may well see some change to over time, depending on the feedback that the government get. But tax laws do change, and so being aware and knowing that your financial advisor is up to date on tax and how it affects a portfolio is really important to make sure that a client does reach out to their advisor each year just to check in and make sure that the right tax regime is being applied. And if you've got a query or question, then I know the team at CP Wealth are more than happy to help answer those questions.
Excellent. Well, thank you very much for your time, Richard. And as you said, any questions or further information required, then please feel free to reach out to the CP Wealth team.
Great to talk to you today, Brittany.
Thanks, you too.